Good day, everyone. Today, I'd like to discuss a fundamental aspect of an investment strategy. So, it's gonna be dividends and capital gains. Now, these two forms of income represents the crux of shareholder returns and have a significant impact on the financial landscape. Now, today we are going to discuss about dividends versus capital gains, the investor choice and implication on those two terms, and how do we make and what is a dividend policy. Now, dividends are the periodic distributions of a company's earnings to its shareholders. These are attractive to investors who seek a lower perceived risk due to the stability of a steady income. In particular, dividends are favored by those looking for current cash flow to meet their financial needs. However, it is essential to note that dividends are taxed when received by shareholders, typically on annual basis. Now, on the other hand, capital gains are the profits realized when an investment is sold at a higher price than the original purchase price. Now, typically, the reason why some investors prefer capital gains includes profits realized when an investment is sold at a higher price. It's actually attractive for tax deferral, avoiding transaction costs and estate planning. Tax only when the asset is sold. Now, I want to present this. No, this is the comparison of the dividends and capital gains, and in terms of the aspect we categorize in terms of nature of operation, risk perception, investor relation preferences, taxation, cost of transaction, holding period impact, implications for stock price, and the dividends relevance theory. Um, Typically, dividends are periodic distribution of company earnings to shareholders, unlike capital gains, where profits are just realized when an investment is sold. Dividends, in terms of risk perception, generally are less risky. Meanwhile, capital gains are riskier since they depend on future market conditions. In terms of investor preferences, investors that are seeking steady income or current cash flows typically prefer to look at dividends rather than capital gains, since capital gains are more favored by those aiming to avoid transaction costs, delay taxes, or those who plan for estate purposes. Meanwhile, in terms of taxation, dividends are taxed when received by shareholders, typically annually, because companies typically, give dividends annually. Meanwhile, capital gains, you are only taxed when the asset is sold, allowing for tax deferrals. Now, in of transaction, dividends normally has minimal transaction costs. Capital gains usually can incur brokerage fees and other taxes. In terms of holding period impact, dividends has no impact um, based on holding period. Meanwhile, capital gains tax treatment can be influenced by holding period. Dividends may affect stock price based on investor perception. Meanwhile, capital gains directly impact stock price upon realization, and irrelevance to the dividend irrelevance theory. Dividends suggest in dividends, it was suggested dividend policy is irrelevant to stock price. Meanwhile, capital gains directly impact stock price. Now, we are now going to discuss about dividend policy. Now, it is crucial to comprehend that dividend policy outline how a company distributes its earnings to shareholders. Now, um, these policies govern when, how, how often, and how much is paid out to the investors. Now, it's essential to note that companies are not obligated to pay dividends, but many investors perceive them as a barometer of a company's financial being. Now, let's explore why establishing a dividend policy is, crucial for companies. Because it affects this, no, investor preferences, investment opportunities, financial obligations, and long-term vision. Now, I would like to um, expound that. First is into the investor preferences. Evaluating your available investment opportunities is essential. So it is important to assess whether if you're a company, you retain your earnings for investment or distributing them as a dividend aligns with your growth strategy. Next is the investment opportunities. Um, no, sorry, investor preferences. Understanding the preferences of your investor is paramount, since you want to know if these investors are they seeking income in form of dividends, or um, are they more focused on capital gains and tax advantages. So this type of knowledge will help you tailor your policy to meet the needs of your investors. Third is the financial obligation. Now, prioritizing financial obligations is another key consideration. Be sure to allocate funds for capex and working capital needs before determining the dividend amount, as maintaining the financial health of your company is critical. You don't want to um, parang butang mo, you 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 raise your dividend too high, yet you no longer has the cash to operate. You don't want that. And then number four, when establishing a dividend policy, um, it's vital to align this dividend policy to your long-term vision. Consider how the policy fits within your company's strategic goals and growth trajectory. Now, I want to highlight this. No, these are the types of dividend policies. We have actually three. One is stable dividend policy, which is in terms of objective, it's steady and predictable annual dividends. Next is the constant dividend policy, where it pays a percentage of earnings as dividends annually, leading to more volatility in dividend income. C is the residual dividend policy. It pays dividends from remaining earnings after covering capital expenditures and working capital needs. Um, I would like to share now that this is our summary of the comparison of these dividend policies. So in terms of consistency of payments, stable dividend policy has consistent annual dividend payments, and then dividends in constant dividend policy, dividends can fluctuate significantly with earnings. Residual dividend policy, variable dividends based on remaining earnings. Um, Also here, I would like to highlight this one, long-term focus. So stable dividend policy emphasizes long-term growth. Constant dividend policy should reflect short-term earnings fluctuation. Residual dividend policy balances shareholder rewards with financial needs. Um, Advantages of the stable dividend policy is it provides a reliable income source for investors. In constant dividend policy, it reflects profitability directly, so there is a high potential for payouts. Residual dividend policy, it ensures financial obligations are met before dividends. So it sounds like it's more beneficial to the company that will issue the dividend. In terms of disadvantages, stable dividend policy may not capitalize on exceptionally profitable years. Meanwhile, constant dividend policy has fluctuating dividends can be challenging for income planning. And then on the residual dividend policy, potential for volatile dividend payments. What is the impact before I wrap up? Impact of a well-established dividend policy. So a well-established dividend policy enhances investor confidence as it provides clarity and transparency regarding the company's commitment to rewarding shareholders. Second, it can significantly impact stock performance. Of course, since we first discussed, dividends can also be a barometer of your company's performance. Next is by aligning with your long-term vision. So a sound dividend policy can support your company's growth strategy and communicate a commitment to shareholders. That's it, and thank you for listening.